Payroll's competition is open. If you'd like to join that, you can see it in the screen there. I shall pop the link in the chat function there. You can either go to that one, or actually I don't think there's comments on that one, so at that go to the link on the tweet instead, because that's where you can reply, and I'll pop that into the chat there. So bingo, yeah, so follow that secondary link if you want to have a go at the NFP competition. Win a free month on the platform for 3 lucky winners. Get closest to the number or the number exactly, and you'll win a free month. Those already on the platform, that will get added to your subscription. All you need to do is follow that link on that Twitter link and put your guess in the comments. First person to the number gets it, but all the rules are on the blog post itself. So good luck for that, and we're expecting 200,000 for Friday's NFP again. I think
that's the number of answers you expect, the guesses.
Is what?
Is that the number of guesses you expect?
Yeah, it's funny. So I think
so. All our listeners better get to work and retweet it.
Yeah, exactly. Get the number and get retweeting. But I think we've expected 200,000 for 3 months on the trot now. Yeah. And the last 2 months, I've guessed 262, and it's come in at I think it was 263 and 261 the last 2 months. So I'm going for the hat trick, and then I can claim pride of place in ForexAnalytix Towers among my colleagues as the NFP champion of the universe. Anyway, have a crack at that. As I say, put your guesses in the comments on that tweet I've posted there, and you'll find the rules there within. All right, on to business. Lots going on in markets in the early start of the year. We've seen a lot of up and down. Had a big dollar buying yesterday, which is pretty much reversed in quite a few pairs, quite many pairs, some breaking to new highs. Now there's a bit of going on in risk as well, as this sort of New Year's jockeying around in markets. So China is been out again with their property market, and they're looking at potentially shoring up the too big to fail developers. So again, putting some resources towards that sector. Maybe the biggest news out of China is, for the Aussie at least, is that authorities are potentially discussing a partial end to the ban on Australian coal. That set a little bit of a fire under the Aussie this morning, which has continued further today as we've seen a bit of dollar weakness coming on top as well. So a bit of a thawing potentially, again, in tensions between Australia and China, who had been having a bit of a spat, and China banned Aussie coal. That may be now reversing, so that's going to be good news for the Aussie. Should keep a bit under it if it's confirmed, and if there's any further easing there. On the virus front, it's still a bit mixed. We're still hearing about cases rising and the problems sweeping across, but it seems that China are going to blunder their way through it. They're going to let people get sick and recover. Obviously those that do, and unfortunately for the poor souls that don't. But they're going to get through the immunity phase of letting everyone catch it and get through it, like a lot of the West is doing and other countries are doing themselves now. So this is something we spoke about before Christmas, whether it would really impact activity or whether it's just going to be something that lasts for a month, 2 months, and then everything gets better. Everyone goes back to work. They have 5, 6, 7 days off, like many people do with this illness, and then they're back to work normally. So it seems the market is looking like it's believing that this is going to be a potentially short-term effect, and then the real reopening will happen, and that'll kickstart Chinese economy once again. For dollar yuan, it's a bit of a mixed picture here. There could be a bit of that positivity feeding through. It's also been mentioned that perhaps there's some seasonal effects going on in here. Well, I say seasonal effects in here, mainly the onshore one, the CNY, in the New Year holidays, some buying of the onshore one coming in here, maybe some drag from pulling the offshore as well. But also we've got this move in the dollar as well, and it's been moving following the dollar a lot as well. So I'm not sure what this one's doing. I'm still long a bit down here through 6.87, and I'll be out. I took a bit of a small long 92.66 something, and a bit more 90.50. Just playing on the minor support down here, and that prior low, as I say, into 88 is that's the line of the recent low. But if we go through 87, then I'll be out, and we're potentially heading further down in this one. Over to Japan. Kuroda starting the year off saying he will continue with monetary easing to achieve the price goal. But there's been some news from PM Kishida. Quite big news, really. He's come out saying he would like to ask firms to achieve wage hikes that exceed the rate of inflation, and he'd like to create an economic structure in which wages rise every year. So he's actively pushing for firms to hike wages above inflation. As we've been saying for many weeks, that's all going to be coming in this first quarter as we head towards the end of the fiscal year in Japan. In this first quarter, when the wage negotiations take place. If we do start seeing above inflation wage increases, that's going to keep inflation bubbling in Japan, and may lead to the Bank of Japan starting to turn a bit more hawkish, maybe sooner than they expect, at least. So that's one to keep an eye on. Is that a bit of a change from Kishida K?
Well, I mean,
coming out and actively pushing.
Well, not really a big change. I recall Abe having done that already, but then the companies were hiding behind costs and things. It would be a big change if they do. Now, we have to bear in mind as well that the Japanese government is giving them a lot of money as well through stimulus packages. So if they would reply positively to it, which we should perhaps hear from them before it all happens. So perhaps from February we could hear a bit of news, but that would be a big change, and we know that that is one of the conditions for the Bank of Japan to change tack, which would then lead probably to more speculation, and rightfully so, of changes in the monetary policy, and the yen likely to strengthen more. But we first have to see how the companies reply. The prior years, the line of good or bad, let's put it that way, was around 2 to 3%. Now we are higher than that. So if the companies would give them less than 3% all in all, that would be bad news. But if it's let's say 3.8, 4%, then I think the yen could see a bit of buyers again.
Now, when they talk price rises, is it across both sectors, so like the public sector and the private sector, or are they just pushing for private sector mainly?
Well, they're pushing for the private sector to follow the move that they will likely put in place for the public sector, right? So yeah, we have to wait for the big companies, the car makers, the machinery makers, those companies, and then see what the big energy companies do, like TEPCO and stuff like that.
So it could be a case that the private sector is going to want to see the government going first and putting their money where their mouth is in the first instance, would you say?
Likely. Oh yeah, and then the banking sector, of course. But I would expect the banking sector to be a little more, how should I say, willing to follow the government moves than the rest. But they are giving work to a lot of people, but also don't forget the car makers and as I said, the machinery makers are worldwide big companies. So those are the ones who will probably tip the scale whether to see whether it's good enough or not.
Yeah, definitely. Okay, let's crack on. Coming over to the European side of things, ECB's Kazakhs sees significant rate increases at the next two meetings, and then the size of rate increases may be smaller in the future, so pushing the ECB narrative of 50 pip hikes to come over the next couple more meetings, maybe more, and then a slowdown from that point. Now, speaking of slowdowns, let's have a quick look at the data. We got a bit of data out yesterday. German CPI coming in lower than expected. A bit of easing price pressures there, and we've seen that across the board in the PMIs, France and elsewhere. Now, for Germany, there is a potential bit of skew in that there were government measures put in place to pay some household gas bills, which is said to have impacted the inflation numbers there. So that may need to, or we may see that washing out in the next print or two. So don't be surprised if that suddenly jumps back up again. Or conversely, as mentioned, the PMIs that have come out this morning, one of the key factors within those is that price pressures have been easing at firms as well. But coming back to the data, nothing really major going on. Canada manufacturing PMI in a little bit lower. The US manufacturing PMI coming in unchanged versus the flash, down from the month before. And then into this morning, more PMI data. As you see, Japan now posting a little rise on that one. German import prices coming in lower than expected again, and lower than the prior month as well. 14.5% versus 18 expected year on year. Month on month down 4.5% there. So we are starting to see a little bit of softness coming in to price numbers. France, as you can see there as well, 5.9%. That was expected to rise 2 pips, and it came in 3 lower than the prior month. The Eurozone measure doing pretty much the same. The PMIs haven't been too bad. Spain ticking up there in the services. Italy, bit better on the final number there in services, but still in contraction. Pretty much the same story for France as well, 49.5 versus 48.1 expected. Germany as well, a little bit better. It's all still in contraction, but perhaps we've stopped the rot. But as mentioned in the details of all these PMIs, the fact that price pressures are easing somewhat could give credence to the fact that maybe we've seen a bit of a top out in inflation for now. We need to see how that continues. Over to the UK. We had some mortgage approval data out. Mortgages down significantly, 46,000 versus 55 expected and 57k prior. But I would say usually the November, December months can be a bit funky because it is the holiday period. No one wants to move house over Christmas, get a mortgage, that sort of stuff. There was a big uptick in lending, though, likely due to the higher rates, people locking in before rates rise further. One thing of note was the Bank of England consumer credit data. That jumped to 1.5 billion, pretty much doubled from the 0.75 billion seen last month. Of that, 1.2 billion was credit card usage, which was up from 400 million in the prior month. That may be significant and something we need to keep an eye on if UK consumers are starting to put a lot of their borrowing on the plastic. Now, obviously, again, it's the holiday period, November, December, Christmas, all that sort of thing. So it's natural to see a boost in spending and the plastic being used at this time of year. We'll have to watch these numbers going into the new year to see if they continue rising on credit cards, because that would indicate some stresses coming into household finances. If we start to see those stresses, that can then impact down the chain. We start seeing potential weakness in retail sales. if folks are struggling, if companies are struggling, if we're going to see a contraction, a recession, that then also puts pressure on the jobs market. We could see more people becoming unemployed. It can become a bit of a snowball to how deep contraction in the economy may be and a recession. If it all washes out in January and these credit card numbers come down again, then that would take a bit of heat off those thoughts, and maybe the recession won't be as bad as some predict. But then moving on to the inflation front, there's been some smaller retail data, price data coming out. It's a little bit mixed. The British Retail Consortium, the BRC, said that UK food inflation was up to a record 13.3% annually versus 12.4% prior, and that fresh produce was up 15% in December versus 14.3% prior. But another survey from Kantar said that food price rises fell for a second month. They had food prices at 14.4% year on year versus 14.6% in November. And they did say that overall sales hit a record 12.8 billion in December. They said that shoppers were spending extra 1.1 billion this December compared to last year, and a lot of that was driven higher by a boom in demand for cold and flu medicines. So a bit of a retail splurge coming into the latter part of the year. Again, something to keep an eye on. We could get good numbers for retail sales that fall off a cliff when we get the January numbers in February. So at the moment, it's, as I've said with the US retail sales, it's a difficult time of year to get a full gauge on this sort of thing. You need to take November, December together as a sort of maybe an average for retail sales, and then see what happens in January. Is there a big fall off the cliff, if you like, in retail sales? So that was it from the UK stuff, and a lot of headlines. The data later today, we have the ISM, JOLTS. It's ISM manufacturing, so a bit of big data coming in there. As you can see there, the data expected on the calendar, 48.3, so a little dip from last month. Kay, you got any headlines, anything you've picked up on?
No, I think market-wise, that's about it. Good roundup of what is going on the headline front.
Cool beans. Okay, so let's have a quick look at markets. So dollar yen a bit all over the show at the moment. Give or take a few pips, it has held 130 again. It didn't quite get down to this low that we saw yesterday. So maybe that's a signal that we might find a bit of a bottom around about this, 129.5, 129.80, around 130, that sort of area. I don't think this really knows what it wants to do just yet. Japan is back in their desks today. I think they're back today.
Yes, they were.
They were back today, yeah. So I'm still short this one. Happy to stay short, see where it wants to go. But I'll be keeping an eye on these lows down here. Got some areas down to 129.30s. Let's take it out a little bit. Go on to a daily. So a bit of a traffic area here. This 61.8 fib could be important because it could be pretty much be a maker or breaker for this phase of the trend. And obviously we've come a long way already, but if we get under here, then we could be heading towards the mid to low 120s fairly soon thereafter. On the yield front, not looking like there's too much going on. Still holding a bit softer after we got that late year rally. Not looking like it wants to go back to there. That 3.4 area is going to be pretty important, I should think. That's where we were in the latter part of the year before we got into the end of year stuff. This one's going to be going on where the market thinks the Fed ceiling is going to be. For 2 years, which is our rough guide, we're still sitting in this 4.25, 4.75 area, 4.5 area. That's where the market is happy to think that the ceiling is potentially going to be. It's not pushed up to that 5.5% mark that some of the Fed dots were indicating at the last FOMC. So this is still going to be my guide through the early part of 2023 and whatever the Fed does as to where the market thinks rates are ultimately going to go. Any softness under this 4.2 area, likely to see dollar weakness coming in, and the market drawing down expectations for how high Fed rates may go. And as mentioned, Aussie dollar with a bit of a rocket up its arse this morning, coming up to test this 68.70 area, and getting up towards that 50 fib 69.16. We couldn't quite get to the 69 level the last time we were up here. Early deck came in just below it, so there is a bit of resistance coming in at this 69 area. If we do break above that, probably going to need to clear 69.20, and then we should start to see this 68, 70, 80 area, maybe 69 becoming a support point and something to build on. As you know, I've been long this from pretty close to the bottom here. I've been encouraged all the way through that we haven't, we've kept making the higher lows. So we've kept the move in play. We haven't had a proper break and hold under the 66, 70, 80 zone that I had here. So that's kept the move encouraged, but I really want to see this break onto the upside now. And that should get us probably at least up to 70, maybe more. And that should give us another leg. But we've tried, we've been here before, we've tried, we've failed. So really, we've got two levels, this 66.60 and this 67.80, 69 area range at the moment. Go with either side of that. What do you think of this one, Kay? I'm tempted to maybe stick a buy stop in above this fib just to maybe catch another leg up.
You know what? And Aussie got support, got a double tailwind there, right? They got a tailwind from Asia, from China, perhaps. Yeah. They've also got the tailwind with the dollar back to lower levels, and we've seen now the 10 years is slowly dripping back lower on the US 10 years. Yeah, I think it's not going to help the dollar at the start of this year. Well, selectively, let's put it that way, because there's dollars and dollars, and I'll show a couple of different ones a bit later. I think it's all positive, and people know in the room I was long Aussie Kiwi from those down from 106 to 105 basically, and I let the last bit go because and I'll show it. We're in a bit of a resistance area here, with the top end around 108.80, 85, and if that goes, Aussie could get another push in the back higher. It's all a bit positive for the Aussie, right? Because despite not being very well supported by their own by its own central bank, it's how shall I call it? We used to call it, it's got a lot of elasticity, meaning that if it comes down, it has this potential of recovering relatively quickly, and that's usually quite positive for a currency, right?
Yeah.
So yeah, to that extent, I think it's the Aussie is still well supported, and we are, as you were pointing out, at a decent zone here in the Aussie dollar. So this is worth watching. I saw you were just on the Aussie yen. This is one that I'm going to leave alone now, because if you have two currencies which are supported, I'm not really inclined to trade the cross too much, unless we start to really hold $130 yen. And there is one thing though that we should add, is the fourth session in a row when Japan was open that the Bank of Japan has been buying JGBs to prevent the yields from going higher. I'm just seeing that the 10s are very close to the upper limit of the 0.5% in Japan, and I don't really know what to read into it, unless it's just the fact that, okay, we are still here to support the JGB market, and we will not refrain of doing so until we really change policy. But the market seems to more or less ignore it. So I reckon there's enough flows now to keep it towards the top end of the yields, and that should also see yen buyers on dips. So that's why I'm leaving the yen crosses a little bit alone. Although I was tempted yesterday to buy a bit of euro yen when the euro got whacked lower, and I didn't. And on this, since dollar yen was tried sub 130 and then rebounded. I didn't do it, but there's this 136 that you have, and then as you can see, just tagged the low of, what is it, late September or so yesterday.
Yeah.
Again over there, what is it? Yeah, late September, and then we're up again, but we're not up that much right now. So I'm not really inclined, because it's a bit of a flip the coin, I think, to be long yen crosses, because anything can happen on the dollar yen. If it holds here, yeah, then you're in. I think it's a good trade, but we are a bit too close to 130 in dollar yen for my comfort, especially if the US yields continue to slide lower. Which, well, I mean, we are European time zone, but we are back sub 370 now in the tens.
Yeah.
We could go a little bit lower again and do what we did towards the year end. If you go, onto the 1 hour. So go on to around the 22nd of September, we were trading a low 360s. So we've got another 10 BPs, I think, in the 10-year to get back to pre-year end levels. So that's going to be an important one, in my opinion. We start to get below 360 on the US 10s, then I think the dollar will get another knock on the head, at least in the shorter term. I'm a bit I overall, globally, I don't think the dollar is dead yet, but for now, I'm not really bullish on the dollar. I must say.
Yeah, no, quite agree, and the same for the yen.
And on the yen, I'll show it. There's already a bit of resistance in the 131s. Of course, we have the big 134.5, but that's 400 points higher than we are now.
Do you want to take it, mate, and show your chart?
I can share a few things.
Yeah.
Oh, no.
There we go. But yeah, I think being short yen in versus anything is probably the path of most resistance at the moment. So if you are trading it from the short side, you might want to be a bit nippy with your trades. I'm not saying sitting too long.
Be a bit careful. I'd say be a bit careful here, as Ryan was already showing. So there's this 61.8 of the move from here, this one, when we that was when when in September 2021, where the Fed really started to pivot, and the 50% is right here, around 130.5, and then if you go on the wider one, that's where your 50% is in the 127.5. And that's where I've got a longer term trend line coming in as well. That's going to be, in my opinion, a very, very, very big zone. And if we then go back onto the shorter term, we are starting to build quite a bit of resistance. Yeah, we tagged the 134.5 here into year end, and then we had this sharp drop lower. And yesterday we already couldn't make it above this 131.50, 60. So that's going to be the first resistance, in my opinion. And then there's a few building now already in between 133 and then back to 134.5. But as you say, if we start to break below 130 again and hold below, and you know, speculators, they do one thing 1 year, and then they do the other thing the next year, and people who are in this kind of market, they won't let go easily, right? So now they think they got the bone between their teeth, and they can chew on it. And also, for as long as we are not going to produce higher lows here, we probably are also in seeing some model fund flows who are always in the direction of the market, who don't counter trade the market. They just go into the direction of the market. So the lower we go, the more they will sell. And as I was saying as well, as we can see here, the US 10s are getting back sub this 370, and then on the 4 hours, you got these 366s, those 360 here, 363. I think that's going to be important as well. And if we continue to slip and slide, I expect the dollar to remain on the defensive for now, at least. Okay, then I've got a couple of other things to look at. Well, first of all, a quick look at the cable. It hasn't been affected too much by expectations. We had this drop yesterday on the opening of the year, where the dollar got bought pretty aggressively during a few hours, and we stopped right on the 30th of November low. And in the meantime, we're already back to higher levels, back to where roughly we closed or opened the year. So from here on, it's again going to be, well, we have this really small term wedge here, or depends how you call it. There's a bit of resistance around 120, 80, 90, but I think the main one again for the shorter term is going to be around here. That's where there's always been a lot of traffic in this 121, call it 1540 zone. That's going to be relatively important, I think, for the cable in the short term. If we start to get back below 120.15, 120, that in the short term would be a bit bad news. But I don't really see, for now at least, a big driver in sterling as such. The other one that we have been playing in the room, and I know Ryan is on it. I know a good few other people are on it as well, is this long in the euro sterling. So yesterday, it seems that this zone, this block, I thought on the break and the hold, we could start to build up on fresh moves, but it does look like we're having a bit of the same scenario as what we have seen around 87. Is that we are doing a bit of ping pong between this is the latest move, right, from the end of the year, and the 50% is around 87, 80, which is what we've seen yesterday on the retracement. And on the top side, we are having difficulties to get back above this 88, 20, 30 zone. So perhaps we are in for a bit of ping pong in this, call it 87, 3/4, 88 1/4. But I think not a lot has changed in the meantime. ECB still pretty hawkish, their members, and the UK situation is, I wouldn't say worse than before. It's not worse than before, but it's like hobbing and bobbing around a little bit, but it's not doing a lot better for the time being. So the divergence that we can see between both blocks, I think, is going to continue for as long as we don't break below this one. This one is now going to be important, in my opinion. Call it 86, 85 figure. This is going to be the important one for the euro sterling. If it breaks below here, well, that's my personal view only. The party could be over, and we could get back into the 85s. But for as long as that holds, people know in the room I'm selling on the way up, I'm buying back on the way down, I'm trying to around the core long, and I intend to do so for as long as this zone holds.
So I've got a quick question for you on the euro. If we are going to see inflation heading lower, will we start thinking about an ECB pivot?
I was actually going to mention it, those inflation data, and then I forgot about it. Thanks for bringing it up. Well, you know my view on inflation, and the expectations are for inflation to come back down, but ECB so far had underestimated inflation, right? So they are still in a catch-up game. And then there's one thing, and I always take the yen as a very good example, because the yen when it was in deflation period for years and years and years, it didn't prevent the yen from strengthening. So inflation is only impacting on a currency to a certain degree. So for me, what I think on the ECB is that they are catching up on the rest of the central banks, so they may stay a bit more hawkish for longer than the rest. And even though inflation data are coming lower, what did we have yesterday? Today in France? Okay, France is getting back below 6%, but then yesterday Germany is still running at 8.5 and 9.5 on the HICP, right? It may be too early for the ECB pivot, in my opinion. If they pivot, of course,
it should be said in context as well that obviously the ECB aren't as hawkish as the Fed have been. You know, they're not expecting rates to go up to 5.5%. So the bar is set a little bit lower. But you know, euro the biggest traded currency. So if there are people who start to get a bit pivoty about the euro, you know, it could be a big mover.
Yeah, it could indeed, and we of course have to pay close attention to that on the euro cross side, on the euro dollar side. But for the time being, I think it's perhaps a bit early for them to start to pivot. But obviously, I mean, as with all trades and as with all currency pairs, we have to respect what is trading right now. So for the time being, euro pairs, apart from some, have been are pausing a bit, and we will see what the real data are going to bring us. Like for today, for instance, I think it's relatively encouraging that we had better revisions on the PMIs. This afternoon is going to be the first response of a PMI in the US, a serious one with the ISM coming out. The other thing is that I saw quite a few articles saying like, oh, the Fed minutes are going to be very important. Personally, I don't think that barring an algo move, it's going to be that important. I think Powell and all his friends have been communicating enough for us to know exactly what's going on, right? I personally don't think the minutes, but I may be wrong, of course, but I personally don't think the minutes are going to change much to the start of the year picture. Not going to be a big driver, right? But in turn, I think the labor report will, because that's going to be we're always talking about the last domino, but that's a hefty and a huge domino. So if that holds on, then I think the dollar can get back some strength. If in turn we are seeing the labor report starting to weaken materially, then I think the dollar will get a serious hit slap around the ears. Right, I just wanted to show a couple of other things. Your Aussie, it's encouraging, right? And as Brian was saying, there's a bit of a was it in the Aussie or in the euro that you were telling Brian? And in the Aussie, there's a bit of a trend line which we held here, and we are already back above the this trend line from coming from a little bit higher. It is encouraging. I think it's really encouraging. Anything low 28s, I may expect to find buyers right there right now. Could already be around 68.30ish, and I wouldn't rule out a test above 69 soon there. Aussie Kiwi, yeah, that's the one, and I've let mine go, and I'm already a little bit because the Aussie is behaving so well. So I've let mine go for two reasons. There's this trend line here, which came in around 108.45, which is around where I let my longs go. And then there's this, which I think is 108.85-ish, is a big one because we came to rest on it a first time on the way down. Then we had this spike back above 110. And then we had like the big collapse on the RBA, RBNZ divergence, taking us down into the even below 105. But to me, this 108.85 is the key. Get a close above, then we may see it back to 110. So I'm going to monitor this one very, very closely on the Aussie Kiwi. If in turn we start to cap and get closes back below 108.40, then we could see at least a correction down to probably low 107s. Now I want to talk about this one, and this is in general. I want to talk about a Norwegian kroner because it's really getting a slap around the ears. We've seen oils coming off, and what I was expecting to happen towards the end of the year seemingly whoops, this one. I'm going to kill this one. Is seemingly happening at the start of it. So I was expecting a bit of Noki weakness into year end. But today, we have seen the Norwegian kroner really getting hammered with lower oils. And then I also think it has to do with perhaps the tax payments being done for now. Perhaps if one of the Scandi people are listening in here, they can confirm that. But Euro Noki is, if we manage to break above this, where is that? Above 1070, 71, I think we could be on our way to, and then 75. Why not move back into the 11s? There is already an interesting short-term level here around 1058.59 to monitor. If that goes back down, then the party may be over. But in the meantime, this is looking pretty beat to me. Dollar Norway, in turn, yesterday we had in the evening we had a violent spike up. I had to change my trend line just a little bit because I did not take this spike into account earlier yesterday. I only had the first one, which is around 1007, 1008. But then this one comes in just around 1010, and we actually perfectly tagged it. So keep an eye on this 1010 zone in dollar Norway. If that would go, we could really spike higher. On the other side, it's a good enough level to monitor closely. Anything else that I'm looking at right now? Yeah, the MEX. Strong Mexican peso, strong. We had this little bit of a channel, which could be a flag. We broken it yesterday, and we haven't looked back. So watch small level here in the 1923s, but looking at how the US yields are slipping and sliding and still like slipping again a couple of tenths of BPs. Yeah, this could be being a 10% currency. This could be going back down to the prior lows that we have seen in November. Data are going to be important for the EM currencies, and I want to remind you of that. It's especially for the MEX. Even US data will be important because the Mexico being seen its proximity, seeing its role as a part of the US manufacturing entities. So keep an eye on what's happening. So actually, paradoxically, if we get good US data, it may be good for the MEX. And then that brings us back to the process because they could be bigger movers than the dollar MEX if the US data are good. This one, Euromex, we're after the visit above 21, we're already back here towards the big support area, which is around 2042, call it 2040. If that goes and we get a close below, we might continue. But I'm respecting it right now. I'm not going to go blindly long makes on those moves. So, but I'm keeping a very close eye on this 2040-42 zone on the Euromex. And for today, Ryan, I think that's enough for me.
Yeah, thank you very much, mate. And yeah, great trading on the Aussie Kiwi. I know you've been banging that drum for quite some time. Nice to see some decent move upside in that. Well, are you looking to reload in dips in that one, or
yeah, definitely. I mean, I'm pretty positive versus the Aussie right now. And oh, I stopped sharing screen, so if you want to take anything back.
Yeah, I can take it back,
yeah, I'm pretty positive Aussie right now. I'm not riding the Aussie dollar train, unfortunately. But yeah, dips. I'm going to be interested in dips again. If I can get some in that 107.5 down to 107 zone, I'll probably reload a few.
Yeah, good stuff, mate. Good stuff.
All right.
Well, I've not got much more to add to the picture than we've already today, so we might call that a show for today. Just in case you did miss it earlier, don't forget to enter our non-farm payrolls competition. I'll put the linky dink in there for you again. Oh, there we go. Oh, I put the wrong one. Hang on. Oh, come on. Wakey. Where are we? I've lost it. There we go. Bingo. Bango. Boom. There we are. There. So into that competition there and win a free month on the ForexAnalytix platform. Yeah, I think we'll have still back tomorrow. So maybe I'll get him to have a little look around the metals. That sort of thing. Keep an eye on the data today. It is a busy week.
Yeah, I forgot about the metals.
What?
I forgot about the metals because
you forgot about the metals. Naughty. See, look, can't get the stuff these days. Do you want to have a quick look?
Yeah.
Or you want to save it tomorrow?
Yeah, let me quickly share them.
Yeah, go ahead, mate.
Okay. Right. So the first one, which is not breaking yet, that's the silver. We were in this big downward channel from the highs, from the 30s. We're still hesitant, but we are gradually coming back, banging our against it again. I think if this 24, 50, 55 can go, there's a case for it to trade a bit higher, especially with the dollar being on the defensive right now. So keep an eye on this 24, 50, 55. If in turn it gaps again, why not go down to mid 23s again before doing the next step? But I'm really monitoring this closely. If it breaks and it holds, I think I may reload some of what I've sold on the way up of my long-term position. And then last but not least, gold looks to have broken. There was also the F.A.C.E resistance around 1845 prior highs, this channel, and it's gone. 1850 is now going to be the first support. 45.50 on gold is going to be the first support, in my opinion. And there is, to me, a real chance, looking at this move and looking at how the dollar rates are slipping, that we get to have a look at 1900 again. Why not? I'm not sure that, since it's still the start of the year, that we can really fly up to 19 3/4, 1975 again. But it is, whatever we want to, however we want to turn it, it is really positive right now. And so 1900 is very plausible, in my opinion. If in turn we start to go back down below 1845, then I think we're going to range a bit between 1800 and 1845. So that's my quick look on the metals for today.
Thank you very much, mate. And we'll call it a day from there again. Second time we'll call it a day today. Thank you very much to everyone for coming to the Flow Show as always. And as always, if you see a tweet for the show, please do retweet it for us. Let's get our name out there. We get plenty more people in here, get some more comments, some more views, and that sort of thing. And until then, we shall see you tomorrow. Have a great trading day ahead. Thank you very much. Cheers, Kay.
Bye, guys.